Accounting is about the property or assets of businesses and the related property rights or equity. Businesses typically own many types of assets: equipment, office supplies, buildings, and reserves of money. They frequently purchase items on credit, so business owners rarely have full equity in the assets. Buying on credit creates liabilities, another word for creditors' financial claims. The property or assets owned by a business is equal to the financial claims, the creditor's claim or liabilities, plus the owner's claim or owner's equity. Suppose you want to buy a $100 lock for your mountain bike, but you only have $60. You decide to pay the store $60 and sign an agreement to pay the remaining $40 over the next 2 months. In this case, the property or asset worth $100 is equal to the financial claims, the creditor's claim, or liability of $40, plus the owner's claim or equity of $60. In accounting, assets are not grouped together and totaled in a single account. Instead, each type of asset owned by a business is given its own account name so that the amount spent on it can be tracked separately. Each account is kept up to date to indicate the amount of the asset currently owned. One of the most important assets is cash in bank, because a business needs money to pay debts and to buy new items for operating the business. Other accounts are used to record the business's liabilities and the owner's equity. Accounts payable records liabilities, and a capital account records the owner's financial claim to the business's assets. Keeping the accounts up to date means that every change in the business's finances must be recorded. Each transaction affects at least 2 accounts. Suppose Roadrunner Delivery Service purchases a delivery truck for $10,000 cash. You can see from this transaction that the increase to delivery equipment for $10,000 and a decrease to cash in bank for $10,000 results in a net effect of 0 on the accounting equation. Only the amounts in cash and bank, a decrease, and the delivery equipment account, an increase, changed. One asset was exchanged for another asset. Because the company now owns more equipment, a new type of equipment, a new account is opened and the account has been increased by $10,000. The new delivery truck was purchased with cash, so the cash and bank account has been decreased by $10,000. Notice how this double entry kept the equation in balance. Now, look at a second transaction in which $3,000 of supplies is purchased on account. The office supplies account is increased because the company now owns an additional $3,000 worth of supplies. The accounts payable account is also increased because the company purchased the supplies on credit, resulting in more company debt. Once again, the accounting equation remains in balance.
Read the business transaction, then drag the labels below to the correct location in the equation. Click Check when you are ready to review your work.